Max Keiser. Welcome to On the Edge. Time now to go to Dublin and speak with author, blogger, journalist, TV presenter, and host of the annual economics festival, Kilkenomics, David McWilliams. Welcome to On the Edge.
Max, it's lovely to be back with you. How are you doing?
All right, fantastic. Let's get into Ireland's problems now. The world's eyes have been focused on Greece, Spain, Italy, and French banks. But nobody talks about the Irish basket case anymore. Why is that, and what's going on?
Well, it doesn't mean that we're not a basket case. In actual fact, the latest data in Ireland, I'll come back to what's going on, but just have a look at what's happening in Ireland. The latest data in Ireland shows unemployment rising, emigration rising, and inflation rising. So, are not so much rising, but remaining stubbornly high. So the general view of the austerity fetishists who say that the more austerity we will have, prices will fall, we'll get competitive, and ultimately the cost in unemployment will be less than it would be if we took any other policy, have been proved wrong. What is happening is prices are not falling, they're actually remaining sticky, and the reason is very simple, that the insiders in a job don't want their wages to fall, but the outsiders who don't have a job can't get a job unless wages fall and they become attractive. So it's a battle between different people within Ireland. That's number one. And number two, of course, people are emigrating in huge numbers and unemployment is rising phenomenally. So the austerity that is supposed to be working now, Max, we're 3 years into this particular policy, is not working. In actual fact, it is doing what Basic Economics 101, as you say in America, or what we'd say here in Ireland, Leaving Cert Economics, tells us is that when you crunch demand to such an extent as we are doing, unemployment rises and prices don't fall because they're sticky. So ultimately, you've got to look at another way of looking at things. The reason Ireland has fallen off the news to an extent, I suppose, has been superseded by worse events elsewhere. During the summer, our bond yields came back in quite dramatically, which was a surprise to me. But they only came back in if you expect Germany to pay for everyone. If you expect Germany to pay for everyone, Max, then you might as well buy Irish bond yields at 10%, Irish bonds at 10%, yielding 10%, and sell Italian, or rather than buy Spanish, buy Irish. So the arbitrage is between the delinquents, Max. It's not between the virtuous and the delinquents. What we're seeing now is an arbitrage between the delinquents, whereby if the market expects Germany to pay for everything in some big bang solution, I'm not too sure they will, but if you expect that to be the case, why not buy Ireland and sell Spain or Portugal or Italy? And that's what's been happening.
When I spoke with you last time when I was visiting Dublin, you were talking about the deposits in Irish banks were leaving. Is that still the case? Is the flows for deposits still out? Is that what you're saying?
Yes, that is still the case. It's not as aggressive as it was, but there is still a net outflow. And the way you see this, more than looking at the data, Max, is you look at the extraordinary reticence of the Irish government to entertain any new banking interest. The Irish government is not making it easy for new players to come in, and the reason is very simple. Deposits are now gold in Ireland. So consequently, the Irish government doesn't want to open up the banking system to new entrants because that will undermine the deposit base of the existing banks, which the Irish government has bailed out in huge billion-euro transfers, buying shares in these banks and buying equity stakes in these banks. So ultimately what you have is the government is now a hostage to its own previous policy, and consequently the banking system is stuck. There is very little credit. Money supply is falling and has been doing for a long time in Ireland. And what you have is a credit crunch on the one hand, but a genuflection to the money lender, the ECB, on the other hand, whereby the state, whatever little bit of cash we have, we're squeezing it, we're giving it over to our creditors, and the economy is contracting, as basic Leaving Cert or 101 economics would tell you would necessarily be the case.
Now, David McWilliams, historically, there have been divisions in Ireland, and they fall along religious and geographic lines. You've got Northern Ireland and everybody in the South. But what you're describing here is a new division between the bailed out, too big to fail bankers whose salaries and wages are remaining high and contributing to inflation, and everybody else.
Well, I don't think it's that, Max. But what I do think is that it's not necessarily exclusively the fault of those who still have very handsome salaries. That's more of a moral issue than anything else. That is making people very, very angry. For example, the head of the civil service here retired last week or 2 weeks ago, a civil service that presided over a monumental policy disaster in Ireland. And the guy got a golden handshake of 707,000 euros. Now, people here are very angry about that, not least because if we are a state allegedly in receivership, well, then ultimately the preferred creditors of the state in receivership should not necessarily be the already wealthy, but they should be the struggling poor. So that's a moral argument. What is happening here, and it's happening all over Europe, and you can see it this afternoon, is we've moved from a democracy where, broadly speaking, economics was instrumental in trying to raise the level of the average guy, to a bankocracy where, broadly speaking, economics was entirely funneled to raise the prospects of the banks, to now what you could call almost a banktatorship, where a tiny, tiny bunch of bankers at the top, both in Ireland and in Europe, are dictating policy to the democratically elected government. And that's what we're seeing going on in Europe this afternoon, when Tim Geithner flies over to advise the European finance ministers as to what to do. So what you have is it's always a case as a citizen. You've got to look at the democratic side of things. Number one, the economic solution ain't working, which is bad enough. But number two, the economic solution is creating a banktatorship, not a bankocracy, a banktatorship where a small amount of people whose interests are in the banks are driving economic policy, not just here in Ireland, but everywhere else, Greece included, but clearly now in France and to a lesser extent in Germany.
All right, now I want to roll back here for a second because you mentioned the Irish bonds, they're yielding 10%, and that if you have a European-wide bailout from Germany, and it looks like with Christine Lagarde, the new IMF chair, coming in, and Geithner coming in, they're going to create a kind of Euro-wide TARP super fund lending facility bailout. So it sounds, and your background, of course, is in banking. So can you pitch me on these 10% Irish bonds? I mean, is this actually a place to put my money?
They're not yielding 10 anymore, they're yielding 8, so they're actually going down. Precisely, if you think about the trade, the arbitrage is between ourselves, the Italians, and the Greeks. Not the Greeks. The Greeks are stratospheric. They're off the radar screen because they will default. But if you think the game is an arbitrage between Italy, Spain, and Ireland is out yielding 10, 9, 8. The Italians are yielding 5, 6, 7. There's a very simple play. You buy the Irish, you sell the Italian, because at the end of the day, Angela Merkel's going to pay, if that is your assumption. But you're absolutely right. It seems that Tim Geithner will come and wave his magic wand, and his magic wand will be a TARP for Europe. But you and I know that the only reason TARP worked was because you had quantitative easing simultaneously. So it was more like an inflationary mirage, whereby you inject capital into the banks in equity, in preferred stock. You wait, you say, okay, what's going to happen to the banks? But at the same time, you inject liquidity into the market via quantitative easing. Of course, what happens, the liquidity doesn't get out into the average guy on the main street, which is why unemployment in the United States remains stubbornly high. It goes into the financial system. And consequently, the liquidity that was meant to go to Main Street goes into the share prices of the banks, drives them up. And the Americans say TARP has been successful. But what all you're doing is you're inflating at one end by quantitative easing, and you're validating, on the other hand, your preferred stock position. But we know that basically you're debasing the asset all the time. So that's what has to happen in Europe. And this is the interesting thing, whether the European Central Bank will do one of two things. On the one hand, it may well take stock in the French banks, for example. But to validate that and to make a profit, they're going to have a monumental quantitative easing in order to drive share prices up. And as you and I know, it's simply a mirage. Share prices are not rising because of growth prospects down the road, but they're rising because liquidity is nowhere else to go.
Right, well, it's a mirage if you're an arbitrageur and you're splitting the difference between these two sovereign debts. However, for people on the ground who are living through this, they experience something called financial oppression, which means that in order for this Euro TARP to go through and for there to be a re-securitization of all this debt once again and rolled into some new credit facility, interest rates have got to be near zero. And that penalizes a huge portion of the population. Talk to us about that, David McWilliams.
Well, interest rates have to be negative, actually. Not near zero, they have to be negative. The rate of inflation in Europe, I think it's about 2 and a bit %. So you've got to have zero nominal interest rates, negative, as in -2 real interest rates, and in so doing, you're absolutely right, you penalise savers in Europe, and it means the Germans will in effect cannibalise themselves because they're the biggest savers in Europe. The Germans have always been. Many years ago, I wrote a book called The Pope's Children in 2005, when Irish people were saying, where's all the money coming from? I created a little fictitious German character to try and explain who this was. He was a parsimonious chap, an elderly man, and he was a huge saver, and his savings were finding their way into Ireland, and we were spending them on Mercedes and BMWs, which were made by the Germans in the first place. So the Germans were quids in both ways. But what I was trying to explain there is that the bedrock of the German economy is a stoic, reasonably prudential saver. Now, if to bail out the French and German banks, you're going to have negative real interest rates, as you are seeing in the United States, well, then what you do is you cannibalize your own monetary base, in effect, which is your savings. And consequently, Angela Merkel is going to have to think long and hard, which is why I don't believe the arbitrage that we spoke about earlier on is a permanent arbitrage. I believe it's a temporary opportunity, not a permanent status quo. And I think that the European banks and the European sovereigns will blow out again because the levels of debt, Max, are just too big.
Okay, so this looks like it's heading for a bit of a train wreck. A couple of points. Number one, the tax rate in Ireland, which has been favorable for decades, has brought in a lot of corporations there, but that's apparently was or is on the table in terms of the IMF bailout. And number two, just real estate prices themselves trending down for many years after the bust. What do you see there?
Well, I mean, I'll answer the first one first. Everybody knows in Europe, Sarkozy included, that changing the Irish corporation tax rate is not going to solve the European banking crisis. So to link the two of them together, which is to link the presence of, let's say, Intel or Microsoft or any large Keiser, any large American company in Ireland with the balance sheet of BNP is fallacious. It's ludicrous. So then you're not into the realms of economics. You're in the realms of politics and sort of bitchiness and how do we, if France's objective is to punish Ireland for our bad behavior, then clearly they will make up some sort of link between the presence of Microsoft in Dublin and the balance sheets of Soc Gen. But you and I know that that's complete nonsense. But they will try to do so. If that were to lead to a change in our tax rate in terms of the corporation tax, it would probably have some negative effects, although I'm not too sure how negative the effects would be given quite how much corporate America has invested in Ireland. Just to put a figure in the back of your head, corporate America has invested twice as much in Ireland as it has done in China and India combined. It has invested more in Ireland than it has invested in all the BRIC countries. So that's China, India, Russia, and Brazil combined. So, it's not about to leave overnight because of a change in the tax rate. That's the first thing. But clearly, it's fallacious and mendacious to link the two together. As I was saying, Soc Gen's balance sheet and Microsoft's decision to be here. Second aspect is back home to the local, to the extent to which property prices, which I believe will fall for the next 5 years. So that would be a 10-year property decline. What is happening is clearly you're just bankrupting the middle classes. The middle classes max on their balance sheet. On the one side, they've got all these assets called property, which are falling in value. And on the other side, they have all these debts, which are rising in cost. And consequently, you're getting a middle class which is bust. It's called a balance sheet recession, which is why austerity won't work. It is why the debt forgiveness, debt renegotiation, and ultimately debt default in Ireland is the only thing that will improve our balance sheet. You know, and I know, and everybody watching your show knows that you don't improve a balance sheet which is already encumbered by debt by incurring more debt. You clearly improve it by incurring less debt. And that's why Ireland must, together, I believe, with Greece and other countries, move towards a debt solution which involves writing off significant amounts of Irish sovereign and bank debt. If we don't, we will simply go back to where we were in the summer, and you will find another financing crisis in Ireland over the course of the next 6 to 8 months.
Yeah, let me ask you a question to compare something that's going on there in Ireland with this Euro TARP Geithner Christine Lagarde engineered lending facility that seems to be coming on board. let's talk about NAMA for a second, because NAMA is to the Irish real estate collapse what this new Eurotarp is to the Euro collapse. Can you make that comparison?
Well, that's fair enough. And NAMA, just so your viewers know, was a kind of hybrid bad bank that ended up not being a bad bank. It was a typical Irish solution to an Irish problem. What it did was it bought up assets from the banks, which were backed by land, at a discount, but the discount wasn't half enough given the way the property markets have gone. And the idea was to preserve the bank's balance sheets and over time to release these assets, this land, back on the market, and they would A, get credit going again, which was their big obsession, and B, get the property market moving. In actual fact, neither has happened. NAMA has served to solidify the market where it was supposed to inject liquidity. It has served to coagulate the market, not least because one large state body is now the biggest landowner in Ireland. I believe it's one of the biggest landowners in Europe now. And clearly, when you have civil servants running this type of operation, you don't necessarily get the incentive, as you would do the developer who owns the land, to sell the bloody stuff and move it on. So you have a pretty interesting comparison between the TARP, which is the shares, let's say, I'll pick on BNP, not for any reason other than I used to work for them. And let's say they take BNP Paribas shares. The only issue there is that the quantitative easing, which happened in the United States, has a much more dramatic and accelerated effect on share prices because they're liquid than it would do on land prices because they're illiquid.
Let me ask you about Greece for a second, because Greece and Ireland are often mentioned in the same breath. Now, Greece saw violent resistance to any IMF-imposed austerity measures, and how are the IMF-imposed austerity measures going in Ireland? In other words, in Greece you had certainly a street reaction, but the reforms are being jammed through anyway. In Ireland, there wasn't so much of a street reaction, and the reforms are being jammed through anyway. Well,
the Greeks have maintained the government, which is amazing. In Ireland, the government was voted out. Fianna Fáil, the party of power for the last 10, arguably the last 100 years, was decimated in the election, so much so that they don't have one sitting member of parliament in the entire city of Dublin, which is an extraordinary thing. So there has been political change. It was expressed in the balance sheet, or the ballot box. However, what is annoying for many people is that the opposition, who fought on a platform of no more money to the banks and it's going to be Labour's way or Frankfurt's way and etc., they have largely come in behind the overall establishment view that you have to get on with things and you have to impose austerity. Now, what they have done is they've managed to impose austerity and explain to the people that there is no alternative. And consequently, the political reaction has been quite muted. Also, maybe there's an argument to say, and I'm not too sure, and maybe some of your Irish viewers will contradict me here, that because a lot of the problems in Ireland are to do with overspending on property, it could be argued that this is almost a middle-class recession, where it's people who've got into negative equity because of their own stupidity. And the last thing they want to do is go out in the street and say, look at me, I'm a stupid one too. I did that. I bought the apartment in Bulgaria, etc. So maybe that's an effect. But it does seem to be rather mooted, all right. And it's hard to have forecast that ahead of time, that the reaction would have been so pliant, the population would be so pliant, and the reaction would have been so nonplussed.
All right, I just want to get back to NAMA for a second, because they've just announced that they are in advanced talks with 3 banks about offering home buyers insurance against house price falls of up to 20%. First of all, before I get into this, could you just, for the viewers, what does NAMA stand for again, just to refresh?
Oh, God, the National Asset Management Agency. The interesting thing is, it's not even an asset. If it was an asset, there would be no reason to have NAMA. It should be called the National Liability Management Agency, NALMA, but it's not. It's called NAMA. That's the first thing. Look, the thing is, NAMA doesn't know what it is. It doesn't know what it wants to be. Now you say it's getting into the insurance market. It's getting into the social housing market. This is what's happened. You have a sort of campaign which initially was supposed to save the banks, and it's now spreading to all sorts of other economic areas in the country. Frankly, you should just close it down. Close it down. At the moment, the only people who are really benefiting from it are valuers, auctioneers, lawyers, accountants, and of course the banks themselves that made the mistakes. So the same people who got us into the problem are now being employed to get us out of the problem. And they haven't lost. In actual fact, they continue to draw salaries. There's some law firms in Dublin City that without NAMA would have closed many, many, many months ago. But NAMA keeps them alive, and so it's job for the boys, and the little guy pays.
All right, finally, David McWilliams, tell us more about Kilkenomics, the festival.
It's in its second year. Last year, myself and a comedy promoter, Richard Cook, who does a great comedy festival called Cat Laughs, sat down, and Richard was asking me about economics, etc. And he said, maybe we should put comedians and economists together. What do you think? And I thought it was a great idea. So he said, okay, you go and get your economics contact book out and get all the people you've worked with and known over the years, and you get them here. I'll get the comedians. We'll bring them together. And the key is that the average guy in Ireland is interested, is fascinated, but is mystified by economics. And the thing about the stand-up comedians is they give the average guy the permission to ask the questions of the Nobel Prize winners, for example. So consequently, what you have is you've got a much more fluid forum than is normally the case in economic debates and discussions. And it's great fun. I mean, it's very simple. Money is serious and comedy is funny. So this is seriously funny. It's a seriously funny weekend. It's from the 4th to the 6th of November. We're delighted to have you. Kilkenny is a lovely city. And amongst the big names who've confirmed, I told you we have Jeff Sachs over from the States. We have John Malden, johnmalden.com over from the States, the single biggest and most successful economic newsletter writer in the United States. And of course, we have people from India and China, as well as our own locals. And one of our big comedians, so a couple of our big comedians who are making it over in Britain are going to come over and host. And of course, we've got Max Keiser. What more can you want from a weekend? If you want more information, it's kilkenomics.com. www.kilkenomics, KILKENOMICS.com.
That's going to do it. Thanks so much, David McWilliams, for being on the edge.
Cheers, guys.
All right, and that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, David McWilliams. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.